Good morning, hunters, and welcome back to the Daily Hunt for Multibaggers. It's Thursday, February 26th, 2026, and we're diving into the data collected from yesterday, Wednesday, the 25th.
You know, Ethan, yesterday was certainly active. We analyzed well over 1,000 posts across 20 different stock symbols. It's a real mixed bag out there, with some truly explosive optimism in certain corners, but also some significant red flags waving in others.
Absolutely, Brooke. We're seeing pockets of intense bullish sentiment, especially around a few key players, suggesting the hunt for growth is very much on. But as you said, caution is still the name of the game for many.
Let's kick things off with Corning, GLW. The social media buzz was quite interesting, with some users celebrating how it's finally beating the S&P 500 thanks to a $6 billion deal with Meta and its role in fiber optics for data centers.
And that's exactly what I love to see, Brooke. Users are pointing to its AI pretty heavy involvement and its diversified portfolio beyond just fiber. Think lithography materials for ASML, touchscreens for Apple. It sounds like a company strategically positioned for future growth, with analysts like Citigroup even raising their price target to $170.
I hear you, Ethan, but we have to look at the numbers. The stock is near its 52-week high, which is great for existing holders, but the price-to-earnings ratio is an eye-watering 82.7, and revenue growth, a modest 0.204. That valuation, well, it's just really stretched, especially when you consider the historical caution from users recalling GLW's multi-decade recovery after the dot-com bubble. Insider selling, though small, also gives me pause.
Fair points on the KPIs, Brooke. It suggests a lot of future growth is already priced in.
Exactly. Our AI-generated analysis leans cautious here. For GLW, it's a stay away.
All right, moving on to the Walt Disney Company, Diz. There was a post declaring, "Never bet against the mouse," and we also saw news about Disney's AI bet and Florida expansion, plus some insider buying. That suggests management sees value.
Never bet against the mouse sounds good on a t-shirt, Ethan, but the sentiment from users was overwhelmingly bearish. People are frustrated, saying the stock didn't go anywhere for extended periods, and it's down across multiple timeframes. The debt-to-equity ratio is an alarming 40.909, which is a huge red flag for me. Even with those healthy profit and operating margins, that debt burden and the modest 5.2% revenue growth are concerning. We previously had Diz as a stay-away back in November, and the financial picture hasn't really improved to shift that perspective.
It's tough to argue with that debt and historical stagnation. For Diz, our AI-generated insight remains a stay away.
Next up, IonQ, INQO. The headline post was about them securing a place in a missile contract, which sounds big.
It does sound promising, doesn't it? And you know, they did report Q4 results, surpassing earnings and revenue estimates, with the CEO calling it an inflection point. There's even been significant insider buying, indicating internal confidence. This is a quantum computing company, Brooke. It's the future.
Future, maybe, Ethan, but the present financial state is deeply concerning. Our AI-generated analysis is bearish. The user sentiment largely dismissed that missile contract as just eligibility to bid, not an actual award. More critically, IonQ has negative EPS of negative 5.84, no net profit margin, and a $12 billion market cap for a company that isn't profitable. That's a very high price-to-book ratio for a company still in its nascent stages. We've rated IonQ as stay away multiple times in the past, and despite the positive earnings estimates being beaten, the actual profitability KPIs haven't shifted enough.
Given the current figures, I agree. For IonQ, it's a stay away. Now for some potential good news, Root Inc., ROOT. There was a big YOLO post about earnings, and the sentiment was predominantly bullish, talking about undervaluation, good growth, and improving profitability.
And for good reason, Ethan. Our AI-generated analysis suggests a buy here. Root delivered strong Q4 25 numbers, with the stock jumping over 12%. Their revenue growth is a healthy 26.9%, and they're actually turning a profit with a positive net profit margin of 3.7% and EPS of 3.55. What's more, insiders have been significantly buying shares, a clear sign of confidence. It's still trading significantly below its 52-week high, suggesting room to run. We had them as a stay away just 2 weeks ago, but these new numbers are changing the game.
This is what we hunt for, companies turning things around. For Root, it's an AI-generated buy. And now the final boss of the AI trade, NVIDIA, NVDA. Yesterday's earnings were highly anticipated, and they absolutely crushed it. We saw posts expecting insane numbers and demanding Q1 fiscal 2027 guidance to confirm the AI supercycle.
And the news confirmed that, Ethan. NVIDIA exceeded Q4 sales and earnings, providing strong Q1 guidance that quells AI demand fears. Morgan Stanley reiterated a buy rating. However, we cannot ignore the incredibly high PE ratio of 48.29 and a market cap of $4.76 trillion. While their revenue growth is exceptional at 62.5% and net profit margin a staggering 53%, the volatility, beta of 2.314, and a somewhat high debt-to-equity ratio of 9.102 mean investors are paying a hefty premium for that growth. We've had a lot of debate on NVIDIA, with many buy and cautious buy ratings.
But the growth is there, Brooke. That 107% return on equity tells you they're just printing money from shareholder capital. They're dominating the AI space, launching new chips, and consistently delivering. This isn't just hype, it's execution. This stock has proven itself time and again. It has, and the numbers are undeniably strong. For NVDA, our AI-generated market commentary is a buy. Finally, let's talk about Tesla, TSLA. There was a post from someone who made a fortune holding it since 2014, but user sentiment for the future seems to be quite cautious. Well, you know Tesla has a track record of innovation, and insiders have been making significant purchases. There's also talk of a strategic pivot towards Optimus robots and software, which could open up entirely new growth avenues, making those past gains look modest if it pays off.
That's a long-term speculative bet, Ethan. Our AI-generated analysis is stay away. The PE ratio is an astronomical 382.9. Combine that with negative revenue growth of negative 3.1% and a net profit margin of only 4%, and you have a valuation that just doesn't make sense on current fundamentals. The stock is down 11% this year, and users are frankly losing faith. We've rated Tesla as stay away or speculative gamble many times before, and the current numbers aren't changing that.
It certainly has a high bar to clear. For TSLA, it's a stay away. All right, let's quickly recap our AI-generated insights for today, Thursday, February 26, 2026. Investigate as buy. Root Inc., ROOT. NVIDIA Corporation, NVDA. Investigate as cautious buy, none. Investigate as speculative gamble, Corning Incorporation, GLW.
And that wraps up another episode of the Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, and happy hunting.
We'll catch you next time.